With markets now hitting new highs, it's definitely getting like FOMO in here. There's a tremendous amount of hype around AI, so I thought it'd be a great opportunity to look at one of the greatest investors, somebody who takes after a name like Warren Buffett. That's going to be Bill Ackman. He is the founder of Pershing Square Capital, and he's a billionaire hedge fund manager, net worth sitting right around $9.4 billion. So yeah, this guy might know a thing or two about investing. And actually, one of his biggest investments and one of his biggest wins was a $60 million investment that turned into a whopping $1.6 billion return. That was his investment in a failing mall operator, General Growth Properties. He's also made some great investments in companies like Wendy's and Chipotle. And we're going to take a look at his very concentrated portfolio. We're going to talk about portfolio management.
A key success factor is you want to have enough money in the bank that you're going to survive, regardless of what's going on with volatility in markets. People who, you shouldn't borrow money. So if you borrow money, you own stocks on margin, markets are going down, and you have your livelihood at risk, it's very difficult to be rational. So key is getting yourself to a place where you're financially secure. Stocks can trade at any price in the short term. And if you know what a business is worth and you understand the management, you know it extremely well, it's not nearly as, it doesn't bother you when a stock price goes down, or it has much less impact on you because again, as Mr. Graham said, in the short term, the market's a voting machine. You have a bunch of lemmings voting one direction. That's concerning. But if it's a great business, doesn't have a lot of debt, and people are going to just listen to more music next year than this year, you're going to do well. I think, now I'm a pretty emotional person, I would say, or I feel pretty strong emotions, but not in investing. I'm remarkably immune to kind of volatility. And that's a big advantage. And it took some time for me to develop that. So it's a bit, again, you can learn a lot from other people's experience. It's one of the few businesses where you can learn an enormous amount by reading about other periods in history, following Buffett's career, the mistakes he made. If you're investing a lot of capital, every one of your mistakes is going to be big.
I thought with the market going to newer highs, a video like this from an expert investor is always good to kind of go back and take a look at how they're thinking, how they're positioned, and what their thought processes are, and how they learn from other investors as well. Now, for 99.9% of people, they should be invested in a well-diversified ETF that has global exposure and that has a low expense. How many stocks should you personally be owning? Now, I definitely believe in more of concentration, and when we look at the market performance, it definitely makes sense that you want to be more concentrated, as roughly a little over 10 names have really carried the majority move of this market. And if you didn't have exposure to those names, well, you've massively underperformed the market, which means that you should have probably just invested in an index and not have been stressed out regardless. Now, what we're looking at right now is Pershing Square's holdings. They recently sold out of Lowe's, but they got a really, really nice gain of 121% on Lowe's. Now, in this video, Bill Ackman did bring up Google and where he found the opportunity when Google was trading for right around 15 times earnings. He thought this was an absolute steal. And the reason being is there was a lot of talk about AI with Microsoft, ChatGPT, and all of a sudden, the valuation of Google seemed to kind of go to the hip side. And this is where he thought the opportunity was, because Google was actually making investments in AI before any other company. He's buying it at a massive discount compared to their peers, and the company has tremendous growth opportunities in the future, even though it was getting overlooked by the market. The market was getting behind these stories, but we all know Google was making these investments years prior to AI becoming a big topic of conversation. And as we can see here, he's up 64%. The only loser in his portfolio is going to be the Howard Hughes holdings, down 22%. One of the areas that Bill Ackman, I think, has an advantage over most is he's really good at picking out restaurants. He's done it with Wendy's, he's done it with Chipotle, and he's done it with a few other restaurants as well. And so this is definitely a strength of his, is picking out these restaurant winners, which to me is actually one of the harder things to do because it tends to be a very volatile, low margin business and usually competitive. Now, once again, in this video, he did talk about owning a certain amount of positions, about 12 to 15 positions, I believe was what he recommended. Now, granted, he's owning right around 7. Do you have a process on figuring out stocks? Do you understand certain business models better than others? And how much time do you really have to dedicate for individual stock picking, following everything from quarterly reports to what management's doing? It becomes very time consuming and actually becomes very stressful. And if you're not beating the market, what actually becomes the point of picking individual stocks? And so how I kind of break it down is, depending on how many hours a week you can contribute, that's how many names you probably should own. Meaning that if you have about 3 hours a week to contribute to individual stock picking, then you probably should only be owning about 3 to 4 names. If you have 5 to 10 hours to contribute to individual stock picking, then maybe you can own 10 to 12 different names, but the vast majority of your portfolio should be a set it and forget it into a well-diversified ETF. And if you do pick those winners, then obviously you're going to outperform the market because you have overexposure to those names. Now, for me personally, I am definitely taking more of a concentrated look at this market. Reason being is, when I look at valuations on the stock market, to me, they are very stretched, but I also think there's tremendous deep value opportunities when we take a look at some of the recent acquisitions that have been made. And I want to talk about one of my largest positions right now. The two positions that I'm holding the majority stake of is going to be Pfizer and Cisco Systems. Now, if you're new to the channel, I just started building into a portfolio, and this is going to be a journey that you can follow along with, and I'll keep you guys up to date. Now, the two things I really like about both these companies is they've made recent acquisitions that have really gotten overlooked by the market. And specifically in this video, I want to talk about Cisco Systems. Now with Pfizer, this is going to be a long turnaround story, but the valuation seems cheap. They are paying over a 6% dividend at the current price. So majority of my returns are probably going to come through dividends over the next couple of years. But I do believe with the acquisition of Seagen, Pfizer will be an absolute player when we talk about cancer treatments. Now, currently, what's the big hot topic? The big hot topics are weight loss and AI, which is making it an unfavorable stock for today, which makes it cheap right now. Now, of course, this could blow up in my face. Pfizer could have massive problems and they could not be a player in valuation. And this could absolutely be a value trap. But on this video, I want to specifically talk about Cisco Systems. Now, Cisco Systems has been making tremendous amount of acquisitions, and they've also started an AI fund that they invested $1 billion in. So where Cisco Systems is trading is basically where it has always traded, meaning that valuation has not appreciated even though the company has made a tremendous amount of investments in the future. And I want to talk through a few different of the investments that they have made and why I think this is a tremendous opportunity and a pretty good value for a very good company. I don't think I'm getting it extremely cheap. I think this is a company that could actually break below $40 a share, currently trading around $47 a share. And this is a company I want to build a massive stake in because I really like what management's doing. I think it's a great company at a good price. And I think there's tremendous growth opportunities that's being overlooked by the market. So when we look at the trailing PE and the forward PE of Cisco Systems, everything is pretty much in line through the last few years, but the company's been making tremendous amounts of investments that is obviously not being priced into the stock, and this is where I personally see the disconnect. Now we can go down a massive laundry list of all the companies that they have acquired, but there's only one I really want to highlight right now, and that's going to be the acquisition of Splunk. Now, Cisco acquired Splunk for $157 a share, which came out to a $28 billion purchase. Obviously, this is a pretty expensive purchase. Now, in my opinion, I do believe that they overpaid, but now that we're looking at what's going on with cybersecurity, maybe they got a really good deal here. So with Splunk, they're doing right around $4.22 billion of revenue for 2024. Now, I look at a company like Palantir, and I'm not trying to compare the two, but the profiles are kind of similar here. Palantir trades for right around a $56 billion market cap and is only doing right around $2.3 billion of revenue, which means Splunk is doing double the revenue of Palantir, but trading at half the valuation. So when I look at this, I'm seeing that, well, Cisco Systems, I'm essentially buying them at the same price that they were 3-4 years ago, but I'm getting Splunk and all the acquisitions that they've been making absolutely free here. And this seems like a big disconnect to me on the stock. Not only is it trading at forward earnings sitting around 13 times, but think about this. With Cisco's network, how many new customers are they going to get while implementing Splunk, which means that that $4.22 billion of revenue could actually skyrocket much faster than everybody anticipated. And that's going to do two things. That's going to grow their top line revenue at a faster pace, but it's also going to grow margins because The Splunk side of their business is a SaaS business, which is a higher margin business, and that means more free cash flow for the company. Now, just a little bit of icing on the cake is obviously going to be this nice 3.3% dividend. It's trading below a market multiple, paying an above average dividend rate, and I think 5+ years out that they are actually going to outgrow earnings versus the S&P 500. So I do think this will be an outperformer. Over the next 1 to 2 years, I think it's going to take time to implement all these businesses that they've acquired, make them run efficient. And unfortunately, I do think there's going to be layoffs taking place because they're not going to need as much workforce as they've acquired a new company, and extra management and extra employees that are most likely not going to be needed because there's some synergies here. So I look at this acquisition and I see that the price hasn't appreciated, but I think they're making great investments. Now, when we look at what Splunk was bought for, $28 billion, and we see some of the valuations on these cybersecurity companies, this is absolutely looking like a steal for Cisco Systems. Now, I do think that a lot of these valuations are stretched, but I also think that Splunk has an advantage because now they have the acceleration of revenue growth with the relationships that Cisco's been building over the last 50 and 60 years. That's an advantage that a lot of other cybersecurity companies do not have. And so this is why it's going to be built out to one of my larger positions, and I'm hoping to get it on a bigger pullback. I would love to build another $5,000 to $10,000 into the position and hold it long term. As always, guys, hopefully you enjoyed the dive in, and we will see you in the next one.